Get Rich Slow with John Wolf. Hey, today we're going to take a dive into USDA. If you watched my basic government loans videos, you heard me tell you that USDA is like the best loan that nobody qualifies for, at least not in and around Portland. And that's not 100% true. I've actually done 3 USDA loans in the last year or so that are just like right around the Portland rim, but it's hard to qualify. So I just want to go through the details. Now, one of the things, first off, 2 things that aren't hard about it. It is 0 down, and the minimum credit score, largely speaking, is a 620. So that's a good point for it. Let's talk about the negative a bit. So first thing, USDA has a maximum income. So you actually can't make too much money or you can't do it. In the Multnomah County, Tri-County area, which is what this really is, plus the income limits are right here, $84,000 or $101,000 if you have 5 or more members of your household. The other thing that's really tough about this loan program is it's not the borrower's income, it's the entire household's income. So 16-year-old summer job counts against that cap. If you have a grandparent who's living with you, even if they're not going on the loan, their Social Security or whatever counts against that cap. The next thing that's really tough is the area restriction. So this here is the map from the USDA, and you can just Google USDA map, and a couple clicks will get you here. Anyways, the entire yellow area is ineligible for USDA loans. So the first place that I see here that you can do it is Corbett. You can do it in Sandy. If you want to go south to Canby, Newburgh, Forest Grove, North Plains, and then you could go up to Ridgefield, Scappoose. So you're going to be pretty far from the center of gravity of Portland over here to get a USDA loan, but that's not actually what knocks most people out of the running, because most people at least understand that there's a map in an area and that makes sense to them. The tough thing to talk about is the debt to income ratio. So again, the debt to income ratio is all of your bills plus the house payment divided by what you make before taxes. That's your debt to income ratio. And for the most part, USDA, you have to be under 39%. And just to compare that, FHA, it is 56%. So that's a big gap. That means if you qualify USDA to do a $200,000 home, you'd be able to do something like a 320 FHA. Now, FHA normally requires 3.5% down, but it doesn't always. For example, in all of Washington, there is a fantastic 0 down FHA program that pretty close to the only rule that's going to matter to most people thinking about doing USDA for 0 down. For the FHA program is the down payment, and the Washington bond program, no down payment for the FHA, lets you buy a lot more house. I've helped quite a few clients on that, and a lot of other people have too. Anyways, that's the important thing to know about USDA. What is great to say about it is the pricing. So we're just going to compare it really quick with FHA again. USDA and FHA have roughly the same interest rates, but the mortgage insurance for FHA is 0.8% for most people, and for USDA it's going to be 0.35% for most people. That's a big savings. Also, the upfront fee rolled into the loan for USDA is going to be 1% for most people. FHA, it's going to be 1.75%. That's also quite a bit more. Just to give you an idea, if you were able to buy the exact same house, USDA or FHA, then 0 down, you would probably have a slightly lower payment USDA than you would with a 3.5% down FHA, because that's really just the way the math stacks. Anyways, have an awesome day. Again, I'm a mortgage lender, Oregon and Washington. So if you want to support me, hit me up if you need a home loan refinance, or like, share, and subscribe this channel. Have an awesome day. Bye.